TILA and RESPA are key parts of the SAFE MLO exam, setting rules for disclosures, consumer protections, and compliance. In this video, we'll cover disclosures, consumer protections, and compliance essentials. And don't miss what's happening in the bottom corner. It's designed to supercharge your exam prep. We'll explain more in just a minute. Let's dive in and get started.
RESPA. Purpose, coverage, and key definitions. What is the primary purpose of the Real Estate Settlement Procedures Act? Is it A, to regulate interest rates on mortgages? B, to ensure transparency in real estate settlements? C, to manage real estate agent licensing? Or D, to control housing market prices? The answer is B, to ensure transparency in real estate settlements. RESPA aims to protect consumers by ensuring they receive disclosures about the costs of real estate settlements and by eliminating abusive practices. It promotes transparency and fairness in the real estate settlement process. A home buyer is confused about the fees listed on their loan estimate. Which RESPA requirement ensures they receive a detailed breakdown of these fees? Is it A, provision of a loan estimate? B, annual escrow statement? C, servicing transfer statement? Or D, home ownership counseling? The answer is A, provision of a loan estimate. RESPA requires lenders to provide a loan estimate which details all settlement costs, ensuring transparency and helping consumers understand the fees involved in their mortgage.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsy.ai for immediate help and a free study session with Birdsy, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
Which of the following transactions is covered under RESPA? Is it A, a commercial property loan? B, a business loan for office equipment? C, a home equity line of credit? Or D, a personal loan for a car? The answer is C, a home equity line of credit. RESPA covers most loans secured by a lien on residential properties, including purchase loans, refinances, and home equity lines of credit. It does not cover commercial or business loans. A lender fails to provide a borrower with a closing disclosure 3 days before closing. What RESPA requirement has been violated? Is it A, provision of a loan estimate? B, annual escrow statement? C, servicing transfer statement? Or D, provision of a closing disclosure? The answer is D, provision of a closing disclosure. RESPA requires lenders to provide a closing disclosure at least 3 business days before closing to ensure borrowers have time to review the terms and costs. Under RESPA, which document must be provided to borrowers to help them understand their mortgage costs? Is it A, loan estimate? B, annual escrow statement? C, servicing transfer statement? Or D, home ownership counseling? The answer is A, loan estimate. The loan estimate is a key document under RESPA designed to provide borrowers with a clear understanding of their mortgage costs and terms early in the loan process. Required disclosures. A borrower receives a servicing disclosure statement indicating their loan may be transferred. What must the lender ensure is included in this disclosure? Is it A, the borrower's credit score? B, the likelihood of loan transfer? C, the lender's profit margin? Or D, the loan's interest rate? The answer is B, the likelihood of loan transfer. The servicing disclosure statement must include information about the likelihood of the loan being sold, transferred, or assigned. This ensures borrowers are aware of potential changes in their loan servicing. What is the primary purpose of the affiliated business arrangement disclosure under RESPA? Is it A, to disclose the loan's interest rate? B, to provide a list of all service providers. C. To inform about business relationships. Or D. To outline the loan repayment terms. The answer is C. To inform about business relationships. The ABA disclosure informs borrowers of any business relationships between the lender and other service providers, ensuring transparency and allowing borrowers to make informed decisions. A homeowner receives an annual Escrow account statement. What key information should this statement provide? Is it A. Account balance and disbursements, B. The homeowner's credit score, C. The lender's profit margin, or D. The loan's interest rate? The answer is A. Account balance and disbursements. The annual escrow account statement should include the account balance, projected disbursements, and any shortages or surpluses, helping homeowners understand their escrow account status. Under RESPA, when must the servicing disclosure statement be provided to the borrower? Is it A. At loan closing, B. Within 30 days of loan approval, C. Upon first payment, or D. Within 3 business days of application? The answer is D. Within 3 business days of application. The servicing disclosure statement must be provided to the borrower within 3 business days of receiving the loan application, ensuring timely disclosure of servicing information. A borrower is informed that their loan servicing will be transferred to another company. What is the minimum notice period required by RESPA for this transfer? Is it A. 30 days after the transfer, B. 5 days before the transfer, C. 15 days before the transfer, or D. On the day of the transfer? The answer is C. 15 days before the transfer. RESPA requires that borrowers be notified at least 15 days before the effective date of the transfer, ensuring they have adequate time to prepare for the change.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Section 8 Prohibitions. A real estate agent offers a mortgage broker a referral fee for every client sent their way. Is this practice compliant with RESPA Section 8? Is it A. Yes, it is compliant, B. No, it violates RESPA Section 8, C. Yes, if disclosed properly, or D. No, unless both parties agree? The answer is B. No, it violates RESPA Section 8. RESPA Section 8 prohibits any referral fees or kickbacks between settlement service providers. Accepting or offering such fees is a violation of the Act. What does RESPA Section 8 specifically prohibit? Is it A. All types of fees, B. Only kickbacks, C. Kickbacks, fee splitting, and unearned fees, or D. Discounts on services? The answer is C. Kickbacks, fee splitting, and unearned fees. RESPA Section 8 prohibits kickbacks, fee splitting, and unearned fees in real estate transactions to ensure transparency and fairness. A title company offers a real estate agent a gift card for every client they refer. Is this allowed under RESPA Section 8? Is it A. Yes, as long as it's under $25, B. Yes, if the client consents, C. No, unless it's disclosed, or D. No, it is a prohibited kickback? The answer is D. No, it is a prohibited kickback. Offering anything of value for referrals is considered a kickback and is prohibited under RESPA Section 8, regardless of the form it takes. Which of the following is an example of fee splitting prohibited by RESPA Section 8? Is it A. Sharing a commission for unperformed services, B. Charging a client for additional services, C. Offering a discount on closing costs, or D. Providing a rebate to a client? The answer is A. Sharing a commission for unperformed services. Fee splitting occurs when 2 parties share a fee for services not performed, which is prohibited under RESPA Section 8. A mortgage lender pays a real estate agent for each client they refer without performing any additional services. Is this compliant with RESPA Section 8? Is it A, yes, if the payment is reasonable? B, yes, if the client agrees? C, no, it is an unearned fee? Or D, no, unless disclosed in writing? The answer is C, no, it is an unearned fee. This is a clear example of an unearned fee, which is prohibited under RESPA Section 8. Payments must be for services actually performed. Escrow account limits and requirements. A homeowner notices that their escrow account balance exceeds the required cushion by $100. What action must the lender take according to RESPA? Is it A, retain the surplus for future payments? B, return the surplus to the borrower within 30 days? C, apply the surplus to the principal balance? Or D, ignore the surplus if it's less than $150? The answer is B, return the surplus to the borrower within 30 days. RESPA mandates that any surplus over $50 in an escrow account must be returned to the borrower within 30 days, unless the surplus is less than $50, in which case it can be credited to the next year's escrow payments. What is the maximum cushion a lender can require in an escrow account under RESPA? Is it A, 2 months of escrow payments? B, 3 months of escrow payments? C, 1 month of escrow payments? Or D, no cushion is allowed? The answer is A, 2 months of escrow payments. RESPA allows lenders to require a cushion of up to 2 months of escrow payments to cover any potential shortfalls in the account. During an annual escrow account analysis, a lender finds a shortage of $200. What options does the lender have under RESPA? Is it A, ignore the shortage? B, demand immediate repayment in full? C, spread the repayment over 12 months? Or D, apply the shortage to the next year's escrow payments? The answer is C, spread the repayment over 12 months. RESPA allows lenders to require borrowers to repay shortages in one lump sum or spread over 12 months. The lender can also choose to do nothing if the shortage is less than 1 month's escrow payment. How often must a lender perform an escrow account analysis under RESPA? Is it A, every 6 months? B, once a year? C, every 2 years? Or D, only when requested by the borrower? The answer is B, once a year. RESPA requires lenders to conduct an escrow account analysis at least once a year to ensure that the account is properly funded and to adjust payments if necessary. A borrower receives a statement showing an escrow account surplus of $75. What should the borrower expect according to RESPA? Is it A, a refund of $75 within 30 days? B, the surplus applied to future payments? C, no action unless the surplus exceeds $100? Or D, an adjustment in the monthly escrow payment? The answer is A, a refund of $75 within 30 days. RESPA requires lenders to refund any surplus over $50 within 30 days unless the borrower agrees to apply it to the next year's payments.
Notice the code in the corner? When you're stumped by a question, enter it at birdsy.ai for immediate help. Enjoy complimentary study sessions and access to hundreds of additional questions to help you pass your exam with confidence.
RESPA enforcement and penalties. A real estate agent receives a referral fee from a title company for directing clients to them. What RESPA violation might this scenario involve? Is it A, no violation? B, kickback violation? C, disclosure violation? Or D, escrow mismanagement? The answer is B, kickback violation. RESPA prohibits kickbacks and referral fees that can increase the cost of settlement services. Accepting a referral fee from a title company is a violation of this rule. What is the maximum penalty per violation for a RESPA violation involving kickbacks? Is it A, $5,000, B, $7,500, C, $10,000, or D, $15,000? The answer is C, $10,000. The maximum penalty for a RESPA violation involving kickbacks is $10,000 per violation. This is intended to deter illegal referral practices. A mortgage lender fails to provide a borrower with a good faith estimate within 3 business days. What RESPA requirement is being violated? Is it A, timely disclosure, B, kickback prohibition, C, escrow account management, or D, servicing transfer notice? The answer is A, timely disclosure. RESPA requires lenders to provide a good faith estimate within 3 business days of receiving a loan application to ensure transparency in settlement costs. Which entity is primarily responsible for enforcing RESPA regulations? Is it A, Federal Reserve, B, Consumer Financial Protection Bureau, C, Department of Housing and Urban Development, or D, Federal Trade Commission? The answer is B, Consumer Financial Protection Bureau. The Consumer Financial Protection Bureau is responsible for enforcing RESPA regulations, ensuring compliance with its provisions. A borrower discovers that their mortgage servicer has not provided an annual escrow statement. What RESPA requirement has been violated? Is it A, timely disclosure, B, kickback prohibition, C, servicing transfer notice, or D, annual escrow statement? The answer is D, annual escrow statement. RESPA requires mortgage servicers to provide borrowers with an annual escrow statement to ensure transparency in the handling of escrow funds. TILA. Purpose, coverage, and key definitions under Regulation Z. A consumer applies for a mortgage loan, and the lender provides a disclosure that includes the APR and finance charge. What is the purpose of this disclosure under TILA? Is it A, to increase lender profits, B, to promote informed use of credit, C, to reduce paperwork for lenders, or D, to eliminate all credit fees? The answer is B, to promote informed use of credit. The disclosure aims to ensure consumers are informed about the cost of credit, enabling them to compare different credit offers effectively. What is the primary purpose of the Truth in Lending Act? Is it A, to promote the informed use of consumer credit, B, to regulate interest rates, C, to eliminate credit card debt, or D, to provide free credit reports? The answer is A, to promote the informed use of consumer credit. The primary purpose of TILA is to promote the informed use of consumer credit by requiring disclosures about its terms and cost. A borrower receives a loan estimate that includes the term finance charge. What does this term represent under Regulation Z? Is it A, the principal loan amount, B, the interest rate only, C, the total cost of credit as a dollar amount, or D, the monthly payment amount? The answer is C, the total cost of credit as a dollar amount. The finance charge represents the total cost of credit as a dollar amount, including interest and other fees, which helps consumers understand the true cost of borrowing. Under TILA, which of the following is considered a key definition? Is it A, credit score, B, loan term, C, down payment, or D, annual percentage rate? The answer is D, annual percentage rate. The annual percentage rate is a key definition under TILA, representing the cost of credit expressed as a yearly interest rate. A lender fails to provide a borrower with the required TILA disclosures before the loan is finalized. What consequence might this have under Regulation Z? Is it A, the borrower may have the right to rescind the loan, B, the loan is automatically void, C, the lender can charge additional fees, Or D, the borrower must accept the loan terms? The answer is A, the borrower may have the right to rescind the loan. Failure to provide required disclosures can lead to penalties for the lender and may give the borrower the right to rescind the loan within a specific period. APR and finance charge calculations. What is the primary purpose of the Truth in Lending Act? Is it A, to regulate interest rates, B, to ensure consumers are informed about credit terms, C, to provide free credit reports, or D, to set minimum credit scores? The answer is B, to ensure consumers are informed about credit terms. The Truth in Lending Act aims to promote informed use of consumer credit by requiring disclosures about terms and costs. It helps consumers compare credit offers more effectively. A borrower receives a loan estimate with an APR of 5.5%. Later, the lender discovers an error and the APR should be 5.7%. What must the lender do under TILA? Is it A, ignore the error, B, adjust the interest rate, C, issue a revised loan estimate, or D, notify the borrower verbally? The answer is C, issue a revised loan estimate. Under TILA, if the APR changes by more than 0.125% for fixed-rate loans, the lender must issue a revised loan estimate to the borrower. Which of the following is included in the finance charge under TILA? Is it A, interest and service fees, B, late payment fees, C, property taxes, or D, down payment? The answer is A, interest and service fees. The finance charge includes interest, service fees, and transaction fees. It represents the cost of borrowing, excluding charges like late fees or taxes. A consumer is comparing two loans, one with a 4.5% APR and another with a 4.7% APR. What should the consumer consider under TILA when choosing a loan? Is it A, the loan with the lower interest rate, B, the loan with the lower APR, C, the loan with the longer term, or D, the loan with fewer fees? The answer is B, the loan with the lower APR. Under TILA, the consumer should consider the APR as it reflects the total cost of borrowing, including interest and fees, allowing for better comparison of loan offers. How often must lenders provide a statement of the finance charge under TILA? Is it A, monthly, B, annually, C, quarterly, or D, at the time of loan agreement? The answer is D, at the time of loan agreement. Lenders must provide a statement of the finance charge at the time of the loan agreement and whenever there are significant changes to the terms.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Right of rescission rules. John refinanced his home and received the necessary disclosures on Monday. When is the last day he can rescind the transaction? Is it A, Wednesday, B, Thursday, C, Friday, or D, Saturday? The answer is B, Thursday. The right of rescission allows borrowers to cancel certain transactions within 3 business days, not including Sundays and federal holidays, from the date of the transaction or receipt of disclosures. What is the primary purpose of the right of rescission under TILA? Is it A, to allow consumers to cancel certain credit transactions within a specific period, B, to provide lenders with a way to retract loan offers, C, to ensure all loan terms are disclosed before signing, or D, to regulate interest rates on consumer loans? The answer is A, to allow consumers to cancel certain credit transactions within a specific period. The right of rescission is designed to protect consumers by allowing them to cancel certain credit transactions within a specified period, providing a safeguard against rushed or uninformed decisions. Emily signed a home equity loan agreement on a Friday and received all disclosures. When does her right to rescind expire? Is it A, Sunday, B, Monday, C, Tuesday, or D, Wednesday? The answer is C, Tuesday. The rescission period is 3 business days, excluding Sundays and federal holidays. Starting from Friday, the period includes Saturday, Monday, and Tuesday. Which transactions are typically subject to the right of rescission under TILA? Is it A, purchase money mortgages, B, loans on second homes, C, auto loans, or D, refinances on a primary residence? The answer is D, refinances on a primary residence. The right of rescission generally applies to refinances and home equity loans on a primary residence, but not to purchase money mortgages or loans on second homes. After receiving the required disclosures, Sarah decides to rescind her loan on the last day of the rescission period. What must she do to ensure her rescission is valid? Is it A, send a written notice to the lender by midnight, B, call the lender before the end of the business day, C, visit the lender's office in person, or D, email the lender after the 3rd business day? The answer is A, send a written notice to the lender by midnight. To rescind, Sarah must notify the lender in writing by midnight of the 3rd business day. This ensures her rescission is legally recognized. HOEPA requirements. A borrower is considering a high-cost mortgage under HOEPA. What must the lender provide to the borrower to comply with disclosure requirements? Is it A, a copy of the borrower's credit report, B, a disclosure notice detailing loan terms and rights, C, a list of alternative lenders, or D, a summary of the lender's financial history? The answer is B, a disclosure notice detailing loan terms and rights. Under HOEPA, lenders must provide a disclosure notice at least 3 business days before the loan is finalized, detailing the loan's terms and the borrower's rights. What is the primary purpose of the Truth in Lending Act? Is it A, to regulate interest rates, B, to provide tax benefits for lenders, C, to ensure consumers are informed about credit terms, or D, to limit the amount of credit available? The answer is C, to ensure consumers are informed about credit terms. TILA's primary purpose is to promote informed use of consumer credit by requiring disclosures about its terms and cost, helping consumers compare credit offers. A lender is evaluating a loan application that qualifies as a higher-priced mortgage loan. What additional requirement must the lender fulfill? Is it A, establish an escrow account for taxes and insurance, B, provide a free credit counseling session, C, offer a lower interest rate, or D, waive all origination fees? The answer is A, establish an escrow account for taxes and insurance. For HPMLs, lenders must establish an escrow account for property taxes and insurance for at least 5 years, ensuring borrower protection. Which of the following is a characteristic of a high-cost mortgage under HOEPA? Is it A, no prepayment penalties, B, low closing costs, C, fixed interest rates only, or D, high fees or interest rates? The answer is D, high fees or interest rates. High-cost mortgages under HOEPA have specific triggers such as high interest rates, high fees, or negative amortization, which require additional consumer protections. What is a requirement for lenders under the HPML rule regarding appraisals? Is it A, provide a free appraisal to the borrower, B, obtain a written appraisal with a physical property visit, C, use only automated valuation models, or D, conduct an appraisal every year? The answer is B, obtain a written appraisal with a physical property visit. Under the HPML rule, lenders must obtain a written appraisal based on a physical property visit to ensure accurate property valuation. TILA, advertising rules and trigger terms. A lender advertises a mortgage with a low interest rate but fails to disclose the annual percentage rate. What TILA requirement is being violated? Is it A, disclosure of loan terms, B, disclosure of payment schedule, C, disclosure of APR, or D, disclosure of late fees? The answer is C, disclosure of APR. TILA requires that if an interest rate is advertised, the APR must also be disclosed to ensure consumers understand the true cost of credit. Which of the following is considered a trigger term under TILA, advertising rules? Is it A, the word affordable, B, the amount of down payment, C, the lender's contact information, or D, the word easy? The answer is B, the amount of down payment. Trigger terms include specific credit terms like the amount of down payment, number of payments, and finance charges, which require additional disclosures. A real estate agent includes the phrase "no money down" in an advertisement. What additional information must be disclosed according to TILA? Is it A, APR and terms of repayment, B, the agent's commission rate, C, the property's market value, or D, the closing date? The answer is A, APR and terms of repayment. TILA requires that when a trigger term like no money down is used, additional terms such as the APR, terms of repayment, and other costs must be disclosed. What is the primary purpose of the Truth in Lending Act? Is it A, to regulate interest rates, B, to provide tax benefits, C, to ensure lender profitability, or D, to ensure consumers are informed about credit terms? The answer is D, to ensure consumers are informed about credit terms. TILA aims to promote informed use of consumer credit by requiring disclosures about its terms and cost, helping consumers compare credit offers. A bank's advertisement states only $500 monthly payments for a car loan. What must the bank also disclose under TILA? Is it A, the bank's credit rating, B, APR in terms of repayment, C, the car's fuel efficiency, or D, the loan officer's contact information? The answer is B, APR in terms of repayment. When a specific payment amount is advertised, TILA requires disclosure of the APR, terms of repayment, and any other relevant costs. RESPA integrated disclosures. Loan estimate. What is the maximum number of business days a lender has to deliver the loan estimate after receiving a loan application? Is it A, 1 business day, B, 3 business days, C, 5 business days, or D, 7 business days? The answer is B, 3 business days. The lender must deliver the loan estimate within 3 business days after receiving a loan application to ensure the borrower has enough time to review the terms. A borrower applies for a mortgage on Monday. By which day must the lender provide the loan estimate to comply with TRID regulations? Is it A, Tuesday, B, Wednesday, C, Thursday, or D, Friday? The answer is C, Thursday. The lender must provide the loan estimate by Thursday, which is 3 business days after the application, ensuring compliance with TRID timing requirements. Which of the following is not a required component of the loan estimate under TRID? Is it A, loan terms, B, projected payments, C, costs at closing, or D, borrower's credit score? The answer is D, borrower's credit score. The loan estimate must include loan terms, projected payments, and costs at closing. The borrower's credit score is not required on the loan estimate. A lender receives a loan application on a Friday. If Monday is a federal holiday, by when must the loan estimate be delivered? Is it A, Tuesday, B, Wednesday, C, Thursday, or D, Friday? The answer is B, Wednesday. With Monday as a holiday, the loan estimate must be delivered by Wednesday, 3 business days after the application, excluding the holiday. Under TID, what is the primary purpose of the loan estimate? Is it A, to provide clear information about loan features and costs? B, to finalize the loan agreement? C, to verify the borrower's credit score? Or D, to determine the loan's interest rate? The answer is A, to provide clear information about loan features and costs. The loan estimate's primary purpose is to provide borrowers with clear and concise information about the key features, costs, and risks of the mortgage loan.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Closing disclosure. A borrower receives their closing disclosure 3 business days before closing. If they find an error in the loan terms, what is the most appropriate action? Is it A, proceed with closing as scheduled? B, contact the lender to correct the error? C, wait until closing to discuss the error? Or D, ignore the error if it's minor? The answer is B, contact the lender to correct the error. The borrower should immediately contact the lender to correct any errors. The closing disclosure must be accurate, and any changes may require a new 3-day waiting period. What is the minimum number of business days before closing that a borrower must receive the closing disclosure? Is it A, 3 business days? B, 5 business days? C, 7 business days? Or D, 1 business day? The answer is A, 3 business days. The borrower must receive the closing disclosure at least 3 business days before closing to review the terms and conditions of the loan. A lender sends a revised closing disclosure due to a change in the APR. How does this affect the closing timeline? Is it A, the closing can proceed as scheduled? B, the borrower must sign a waiver to proceed? C, a new 3-day waiting period is required? Or D, the lender must provide a new loan estimate? The answer is C, a new 3-day waiting period is required. A change in the APR requires a new 3-day waiting period to ensure the borrower has time to review the updated terms. Which document provides the final details about the mortgage loan, including loan terms, projected monthly payments, and closing costs? Is it A, loan estimate? B, closing disclosure? C, promissory note? Or D, deed of trust? The answer is B, closing disclosure. The closing disclosure provides the final details about the mortgage loan, ensuring the borrower understands all terms and costs before closing. A borrower receives their closing disclosure but notices the closing costs are higher than expected. What should they verify first? Is it A, contact the title company for clarification? B, request a breakdown of fees from the lender? C, proceed with closing and address later? Or D, compare with the loan estimate for discrepancies? The answer is D, compare with the loan estimate for discrepancies. The borrower should first compare the closing disclosure with the loan estimate to identify any discrepancies in closing costs. Tolerances and changed circumstances. A borrower receives a loan estimate with a certain interest rate, but market conditions change significantly. What should the lender do according to TID rules? Is it A, ignore the change and proceed with the original estimate? B, wait until closing to adjust the interest rate? C, issue a revised loan estimate reflecting the new rate? Or D, cancel the loan application? The answer is C, issue a revised loan estimate reflecting the new rate. If market conditions change significantly, the lender must issue a revised loan estimate reflecting the new interest rate, as this constitutes a changed circumstance under TID. What is the tolerance level for changes in fees that are not subject to zero tolerance under TRID? Is it A, 0%, B, 10%, C, 15%, or D, 20%? The answer is B, 10%. Under TRID, fees not subject to zero tolerance can change by up to 10% in aggregate from the loan estimate to the closing disclosure. A borrower decides to change the loan type from fixed to adjustable rate after receiving the loan estimate. How should the lender respond under TRID? Is it A, issue a revised loan estimate with the new loan terms? B, proceed with the original loan estimate? C, cancel the loan application? Or D, wait until closing to adjust the terms? The answer is A, issue a revised loan estimate with the new loan terms. Changing the loan type is a significant change, requiring the lender to issue a revised loan estimate to reflect the new terms. Which of the following is considered a changed circumstance under TRID? Is it A, the borrower's name, B, the lender's contact information, C, the closing date, or D, a change in the borrower's creditworthiness? The answer is D, a change in the borrower's creditworthiness. A changed circumstance under TRID includes events like a change in the borrower's creditworthiness or a change in the loan amount requested. Under TRID, what is the maximum time frame within which a revised loan estimate must be provided after a changed circumstance? Is it A, 3 business days, B, 5 business days, C, 7 business days, or D, 10 business days? The answer is A, 3 business days. A revised loan estimate must be provided within 3 business days of receiving information about a changed circumstance. Record retention requirements. A lender is reviewing their compliance with TRID record retention requirements. They discover a loan estimate issued 3 years ago. How long must they retain this document? Is it A, 1 year, B, 3 years, C, 5 years, or D, 7 years? The answer is B, 3 years. Under TRID, lenders must retain loan estimates for at least 3 years from the date of consummation. This ensures compliance with federal regulations and facilitates audits. What is the minimum retention period for closing disclosures under TRID? Is it A, 2 years, B, 3 years, C, 5 years, or D, 7 years? The answer is C, 5 years. TRID requires that closing disclosures be retained for at least 5 years from the date of consummation. This ensures that records are available for compliance checks and audits. A mortgage company is conducting an internal audit and finds a closing disclosure from a loan closed 4 years ago. How much longer must they keep this document? Is it A, 1 more year, B, 2 more years, C, 3 more years, or D, no longer needed? The answer is A, 1 more year. TRID requires closing disclosures to be retained for 5 years. Since the loan closed 4 years ago, the document must be kept for 1 more year. Which document must be retained for 3 years according to TRID regulations? Is it A, closing disclosure, B, mortgage note, C, appraisal report, or D, loan estimate? The answer is D, loan estimate. Under TRID, the loan estimate must be retained for at least 3 years from the date of consummation. This ensures compliance with federal regulations. Post-closing and revised disclosures. After closing, a borrower discovers an error in the closing disclosure regarding the loan amount. What is the lender's obligation under TRID? Is it A, ignore the error as the loan has closed, B, issue a corrected closing disclosure within 60 days, C, notify the borrower but take no further action, or D, wait until the borrower requests a correction? The answer is B, issue a corrected closing disclosure within 60 days. Under TRID, if an error is discovered post-closing that affects the closing disclosure, the lender must issue a corrected disclosure within 60 days of closing. What is the time frame for a lender to issue a revised closing disclosure if a post-closing error is identified? Is it A, 30 days, B, 45 days, C, 60 days, or D, 90 days? The answer is C, 60 days. TRID rules require lenders to issue a revised closing disclosure within 60 days of discovering an error post-closing. A borrower receives a revised closing disclosure due to a post-closing change in the loan terms. How should the borrower verify the changes? Is it A, compare it with the original closing disclosure, B, consult with their real estate agent, C, ignore it if the loan has already closed, or D, request a meeting with the lender? The answer is A, compare it with the original closing disclosure. The borrower should compare the revised closing disclosure with the original to ensure all changes are accurately reflected and understood.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit Birdsy.ai for complimentary study sessions with Birdsy, your AI-powered study partner.